These concepts are underpinned by consideration for management of environmental, social, and governance factors that influence and are influenced by company or investments in question. Companies report annually on how they manage these issues, but it can be time-consuming and hence expensive to sift through 300-page reports for each listed company. Consolidated research is definitely required. To this end, Legae Securities has produced an annual report that identifies ESG risks and provides insight into how these can impact on investments. We speak now to Waseem Thokan of Legae to find out more. Welcome, Waseem.
Thank you very much. Good.
That nutshell description, is it more or less accurate?
I would say so. Good. Of course, people are and investors are more likely now in a globalized environment where the world is becoming more integrated to take into account a broader set of risks and opportunities for businesses than the purely financial performance. And this is what ESG is really about. It's about having a holistic view of how companies impact the world, whether that be impacting society, impacting the environment and so forth, and how those risks can potentially come back to impact on the company's operating performance and ultimately financial performance.
So this report that you put together, it's on an annual basis. How do you put the research together, first of all, and how do you present it to readers? Do you say company A faces these risks, etc., or do you look at the risks and then say company ABC are affected?
Essentially what we've done is we've created a scorecard to measure the ESG performance of the top 100 companies. Now, of course, a lot of people have done different work around corporate responsibility, around regulation and so forth. Our view really was that companies suffer from investment risk and come about investment opportunity by virtue of their actual performance. So instead of saying whether companies have disclosed on certain issues or necessarily have policies in particular issues, of course we do include that, but it's a minority of our overall score. The overall majority comes about by virtue of the actual impact that companies have. So to what extent do they emit carbon, for example? To what extent do they kill people within their operations through mining or through accidents and so forth? What is the dispersion between the incomes at the top end of the company and those of the average employees? And our view really is that if companies operate in an unsustainable way along a whole lot of environmental and social metrics, then it gives an indication that they may have to face regulatory or operational risks that constrain their returns to investors over time.
So one could say your report is quite subjective. We've seen others that simply repeat what companies have reported, just raw data, but no opinion. You provide opinion, do you?
Yes, we do. On some level, we provide opinion. Of course, subjectivity always comes into this type of analysis, because ultimately it's qualitative data that you're working with. But our intention at the outset was to remove subjectivity to the greatest possible degree in our actual analysis. So yes, we provide a rating of the companies and particular issues around how the companies have performed along particular issues, but that comes directly out of how the companies have actually disclosed their performance around it. So for example, you'll find within our scorecard that Sasol performs relatively poorly on the environmental score, and that's relatively unsurprising. But it's not because we have, for example, decided, okay, on a fairly arbitrary basis, okay, Sasol 2 out of 10 for environmental or 2 out of 10 for carbon or whatever the case may be. That score comes about because, for example, Sasol emits 70 million tons of carbon CO2 equivalent in the last year, and that means that they are by far and away the highest emitter in the South African context, and they're also also one of the most intense emitters from the perspective of scaling that for revenue. So by virtue of that, it's undeniable that, for example, should the carbon tax come about and government has kind of indicated that it's a possibility, then Sasol will face a material additional tax expense on an annual basis, and that will constrain the return to investors.
That was the next thing I was going to ask you, is the risks you identify, do you quantify them?
Over time, of course, these risks are very difficult to quantify because the probability of them coming about is difficult. Of course, to the extent where it is possible, or issues become clearer and that potentially catalyzes a more concrete discussion around what the magnitude of them is, then we'll attempt to quantify them. But of course, sometimes it's not necessarily possible, and it's important for us, even if it's not possible to quantify them, to bring investors into the mindset that these risks could possibly come about. So for example, I'll give you, again, the carbon tax, government has indicated that they're going to charge around 120 Rand per ton for carbon, which is the price. So of course, 70 million tons times 120 Rand per ton gives you a rough estimate of what the potential expense would be for Sasol on an annual basis. Of course, there are details around that kind of make it uncertain, but that's for example something that's fairly concrete.
It gives you a fair estimate.
A fair estimate. Again, something that may not necessarily have that is something like contract worker usage. So we find that some of the companies within our sample use contract workers for something like 2/3 or more of their workforces. A company like Truworths is an example of that. And the issue really becomes is that we've seen that the amendments to the Labour Relations Act have come through, and there's a serious potential for Truworths to not be able to use contract workers to the same degree, and of course there's a cost implication attached to that. Now, and we know that of course the investability of Truworths is partially defined by the fact that they are a high margin retailer. Now, our question really was to say, to what extent is that high margin supported by the fact that they're able to squeeze down labor costs? And if they're not able to do that, what are the implications for margin? And ultimately, what are the implications for that for investment return? And these are the type of issues that we look at. So, of course, it's important to take into account, sustainability in a broad sense, but at the same time, we're not trying to force companies to, address issues that are not necessarily material to them. We want to make it quite clear that it is in the companies themselves' interest and investors' interest to look at these issues over time.
A question of awareness. Thank you for your time, Waseem.
Thank you very much.